If you were brave enough to log into your brokerage account yesterday, uh, honestly, you probably needed a stiff drink right after.
Oh, absolutely.
We just saw one of the most violent, jaw-dropping 24-hour periods in financial history. And I'm not using hyperbole here.
No, this wasn't just a bad day. We're talking about a historic capitulation event.
Right.
It was staggering. I was glued to the terminal all day, just
Yeah.
watching the red pile up. When you actually sit down and crunch the numbers, we saw, something like $5 trillion in combined market cap just gone, evaporated.
From the precious metals sector alone.
In a single day.
5 trillion. That's a number that is so hard to even visualize. I mean, it's bigger than the GDP of most countries.
It's like the entire economy of Japan just vanished from the ledger in an afternoon.
So let's set the scene for everyone listening. It is Saturday, January 31, 2026.
Yeah.
You are likely waking up, checking your phone, and seeing what can only be described as a crime scene in the markets.
A crime scene is the perfect way to put it. And what makes it so disorienting for people is the whiplash.
Exactly.
I mean, just hours before the crash, literally on Thursday, we were popping champagne. Gold had just touched an all-time high near $5,600.
And silver was trading around $121. It was just absolute euphoria. The to-the-moon crowd was out in full force.
I remember looking at the charts Thursday night and thinking, this is it? The dollar's finally breaking.
That was the sentiment everywhere.
Right.
And then Friday, January 30th happened. The floor didn't just crack.
It completely gave way. The elevator cable snapped.
So today, we are going to do what we do best. We're going to unpack this whole mess. We've got a stack of reports here, exchange data, political wires out of D.C. We're going to look at the mechanical triggers.
The stuff the headlines miss, like the CME margin hikes.
Which played a huge role. But we also have to talk about the massive political shift with the Fed that really acted as the spark.
Oh, the Kevin Warsh nomination changes the entire calculus for the dollar, no question.
And we can't ignore the paradox of oil. Because, you look at your screen, oil is surging while everything else is just getting annihilated. We need to talk about Treasury Secretary Scott Bessent's 333 rule.
And whether it's even feasible. So yeah, it's a lot to cover. But let's start with the anatomy of the crash itself. Because honestly, you look at the charts, it looks like a glitch.
It does. It just goes straight down. So take us back to Thursday, January 29th. Because to understand the crash, you have to understand the mania that came right before it.
It was a classic blow-off top. That's just trader speak for when a price goes parabolic, right?
Yeah.
Logic has left the building, and it's all pure emotion.
And that emotion was fear.
Total fear. Investors were terrified of U.S. debt debasement. They were worried about war, and they just piled in. Gold hit $5,600. Silver hit an intraday high of roughly $121.
So it's a fear trade. People weren't buying silver because they needed to build solar panels that afternoon.
No, of course not. They were buying it because they were scared the dollar was about to implode. It was a hedge against chaos.
But then the sun came up on Friday.
And the music didn't just stop. The lights went out and the doors locked. Silver collapsed over 30%. That is its worst single day since 1980. It fell all the way to the $80 range.
And gold tumbled nearly 10%, dropping to around $4,900.
Yeah.
A 30% drop in a major global commodity in one day that's just unheard of in modern times.
Yeah.
It feels like crypto volatility. But digging into the data, this wasn't just people changing their minds. This was mechanical.
That's the key word, mechanical. The Chicago Mercantile Exchange, the CME, they have to step in.
Okay, so the exchange is like the house in a casino.
Exactly. They have to make sure they don't go bust when volatility spikes. So when prices go parabolic like they did, the exchange has to protect itself.
And they do that by raising margin requirements. Now, for the listener who doesn't trade futures, let's just clarify this. Margin is basically the down payment you have to put up, right?
Correct. It's the collateral. You put down a little cash to control a lot of metal. And on Friday, the CME raised margins on gold from 6% to 8%. For silver, it was a bigger jump, from 11% to 15%.
Now, I can hear people saying, wait, 11 to 15%, that's just 4%. Why does that crash a multi-trillion-dollar market?
Because you have to think in terms of leverage. If you're a trader and you're leveraged 10 to 1, that small hike is massive relative to your cash. If you are leveraged to the hilt and suddenly the exchange says you need to post 40% more cash effectively overnight to keep your position.
And you don't have it.
Then you get the call, the margin call.
To margin call from hell.
And if you can't wire the money immediately, the broker liquidates you. They sell your position at market. Doesn't matter if you love silver or think it's going to 200, you are not allowed to own it anymore.
So you have forced selling, which pushes the price down, which then triggers more margin calls for the next guy who is maybe a little less leveraged.
But now he's underwater, too. It's a cascade. It triggered a deleveraging event we estimate was over $1 billion. But there's another layer here we found in the data, the gamma squeeze.
I saw that term floating around. It sounds like something from a sci-fi movie, but it's just
Right.
math, right? This is about the dealers.
Yes, the big banks. It's a bit technical, but think of it this way. When everyone is buying upside call options, betting the price goes up, the banks are selling those bets.
They're taking the other side.
Right, but banks don't like to gamble. They want to be neutral. So to protect themselves as the price rises, they have to buy the underlying metal. This actually fuels the rally on the way up.
But the math works in reverse, too.
Cruelly so.
Well,
When the price started tanking on Friday from those margin calls, the dealers were suddenly holding way too much metal. To get their books back to neutral, they had to sell.
so the lower the price went.
The more the math dictated they had to sell. It's a doom loop, a complete doom loop. The paper market just broke.
So we have the fuel for the fire, which was all the leverage and the margin hikes.
Yeah.
But every fire needs a spark.
Right.
And looking at the timeline, that match came straight from Washington.
It did. The political dimension here is huge. On Friday, amidst all this chaos, President Trump officially announced the nomination of Kevin Warsh to replace Jerome Powell as Fed chair.
And this is a massive, massive shift in the narrative. Because up until Thursday, the market was betting on, well, chaos, right? They were betting on a Fed that would just print money forever.
The market had priced in a Fed that was losing its independence, that it was going to become this, loose, politicized piggy bank.
Which is the perfect environment for gold.
Oh, it's the dream scenario for gold. It's the ultimate anti-dollar trade. But Kevin Warsh just shatters that entire narrative.
So let's talk about him, because for anyone who isn't a Fed watcher, the name might not ring a bell. Who is Kevin Warsh to Wall Street?
He's a former Fed governor, a Morgan Stanley banker. But critically, he is viewed as a hawk. He has a long history of criticizing the Fed's huge balance sheet. He has argued against what he calls financial repression.
Financial repression, let's define that. That's basically keeping interest rates artificially lower than inflation to burn away government debt.
Exactly. It punishes savers to help the government. It's a stealth tax, and Warsh hates it. He believes in sound money. So the market looks at him and says, wait a minute, this guy isn't a puppet. He might actually defend the dollar.
And that realization just sent the U.S. dollar soaring. I'm looking at the DXY chart here, and it just spiked vertically. And a stronger dollar is kryptonite for commodities.
So it triggered massive profit-taking. It was a textbook case of buy the rumor, sell the news. The rumor was the end of the U.S. financial system.
Old debate.
And the news was the appointment of a competent institutionalist who might actually, bring some discipline back.
It's so ironic, isn't it? The appointment of someone considered responsible causes a massive crash.
It is, but it makes sense. And if you bought gold because you thought the dollar was going to zero, and then a guy gets appointed who says, I'm not letting that happen, you sell your gold. Simple as that.
Now, this transition isn't exactly going to be smooth, though. We still have Jerome Powell in the seat, and things are getting very tense between him and the White House.
Tense is an understatement. We are witnessing a genuine crisis of Fed independence. Powell is currently facing a DOJ investigation.
And this is about building renovations. I saw that headline and thought I misread it. It seemed so trivial.
Ostensibly, yes, the renovation of the Fed building. But Powell has come out swinging. He called it a pretext. He basically thinks the administration is using it to pressure him out.
Wow. A sitting Fed chair, accusing the DOJ of a political hit job.
It is, and it's what fueled that independence crisis narrative that drove gold up in the first place. But the timeline is the tricky part.
Powell's term doesn't end tomorrow.
No, his term as chair ends in May 2026, but technically he could stay on the Board of Governors until 2028. You can't just fire him without cause.
And now the Senate is getting involved.
Right. Key senators like Tom Tillis are vowing to block any nominee until this DOJ investigation is resolved. So we're looking at a messy, volatile transition.
So what's the takeaway? We have a hawk nominee, a sitting chair under investigation, and a Senate threatening gridlock.
It means uncertainty. And usually markets hate uncertainty. But on Friday, the market panicked because Warsh provided the certainty of tighter money. They realized the easy money party might be ending sooner than they thought.
Okay, so while the metals market was melting down and the Fed was in turmoil, something very strange was happening in energy. Oil went up,
The energy paradox. Brent crude surged back above $70 a barrel on Friday.
which should not happen when the dollar's ripping higher. So connect these dots. Why is oil rallying while gold is dying?
Two main drivers, geopolitics and domestic policy. First, the geopolitical risk premium is back. There are renewed fears of the U.S. attacking Iran,
And Iran controls the Strait of Hormuz.
the most important choke point in the world. 20 million barrels of oil a day flow through there. If Iran threatens to close it, $70 oil will look incredibly cheap. So traders are bidding it up as a hedge against war.
So gold was a hedge against monetary failure. Oil is a hedge against military failure.
Precisely. But there's also this new domestic policy, the 333 rule from Treasury Secretary Scott Bessent.
I've seen this. This is their magic formula for 2026. Break it down for us.
It's their economic target, 3% GDP growth, a 3% deficit, and pumping 3 million extra barrels of oil per day.
For 3 million extra barrels. That is a massive amount of supply.
It is. The logic is simple. Energy is the input cost for everything. If you crash the price of oil by flooding the market with supply, you crash inflation. That's the theory, anyway.
But the reality on Friday was different.
Because the reality is messy. At the same time they want more oil, there are threats of tariffs on suppliers. Combined with Middle East tensions, these things are driving prices up in the short term.
So they're trying to press the gas and the brake at the same time.
Exactly, and that complicates the whole picture. If oil stays high because of Iran, inflation stays sticky. If inflation stays sticky, a Chairman Warsh will likely keep rates high.
And if rates stay high, the dollar stays strong, and metals have a hard time. It's all connected.
It's a spider web. You can't touch one part without shaking the whole thing.
It really is.
Yeah.
So let's pivot to the question I know everyone listening is screaming right now. Is the precious metals bull market dead? Was the run to 5,600 just a fever dream?
It's the billion-dollar question. I've been looking at the notes from the major desks, and the consensus seems to be that this is a structural reset, not a trend reversal.
Meaning the long-term story hasn't really changed.
Correct. The easy money phase is over. The leverage, the gamblers who just showed up last week, they've been flushed out. That's painful, but it's healthy. The fundamental drivers are still there.
You mentioned industrial demand earlier, for silver specifically.
It's the floor under the price. The AI revolution requires massive computing power. That means chips and solar panels, and they all need silver. We are still in a massive supply deficit for silver. That hasn't changed.
So the factories still need the metal on Monday morning, even if the paper price on the screen is 30% lower.
And sovereign demand is real. Central banks around the world are still diversifying away from the dollar long term. One day of price action doesn't change that decade-long geopolitical shift.
And let's be honest, the U.S. deficit issues aren't going to be solved overnight, even with a hawk like Warsh.
Not at all. A 3% deficit target is, well, it's ambitious, borderline fantasy maybe. So the long-run debasement argument for holding metals is still very much valid.
From the traders listening, are there specific numbers they should be watching? Where's the concrete floor?
Looking at the technicals, gold has big support around $4,700 to $4,800. For silver, it really needs to hold that $70 to $74 level to keep the trend alive.
We're getting close to those levels now.
We are, but I would warn anyone listening, do not try to be a hero here. This is a volatility trap. Let the dust settle. We don't know what happens when the Asian markets open.
And we have some big events coming up, right? Next week won't be quiet.
Far from it. We have the union budget in India, a massive gold consumer.
Yeah.
Then there are Japanese elections on February 8th. Any move in the yen will shake everything.
So expect more swings.
Absolutely. If you are trading with leverage in this environment, you are taking a massive, massive risk.
It really brings it back to that difference between the paper price on a screen and the actual physical asset.
That's the core conflict. On Friday, the paper market broke because of margins and politics. But the physical reality, the industrial necessity of these materials to power the AI revolution, that hasn't changed at all.
That is a fascinating thought to leave us with. It's a battle between financial derivatives and industrial necessity. Which one eventually wins?
History suggests industrial necessity always wins in the end. You can't print silver. You have to dig it up. But the derivatives market can cause a lot of pain in the meantime.
It's a lot of pain indeed. Well, we're going to keep monitoring the Warsh confirmation hearings and the situation of the Strait of Hormuz. It sounds like 2026 is going to be anything but boring.
Certainly not boring, just hopefully a little less expensive for everyone's portfolios next week.
We can hope.
Uh,
That's all for this deep dive. Thanks for listening, and remember, knowledge is your best hedge. We'll see you next time.